wanted us to compute, number one, the cost of preference shares, cost of ordinary shares, cost of debentures, and market weighted average cost of capital, WCC of the firm. So once given that question and once we've gone through the analysis the same, then things should be very easy on our end. So how are we going to work it out? This is how we're going to consider, my good students. Always have this in mind whenever you're having that. For you to earn all the points, being a quantitative paper, it is important that you start with your formula first. It is very important that you start with your formula first. So the first case, a good examiner wanted us to compute the, of course, cost of preference shares. I know very well that anytime I am required to compute our cost of preference shares, we're going to talk about our preference dividends here. We're going to divide by, of course, the value of what? The value of these shares. If at all I'm having any component of flotation cost, I need to take care of it. If at all I'm having any discount that I'm issuing, then I'll also have to take care of that. In our case, we didn't have all these items. All you are given, my good students here, according to note 1, of course, I'll be having the component of, I'm having, of course, the value, which we've agreed it is 89. The key question would be, how will you determine your dividends? Recall when we started, we say that all times dividends will always be determined on the par value. So the dividends per share here, if I told you we were to determine our dividends, then my dividends in this case, I should be talking of on the par value. I'll be having whatever that you're given in our capital structure, 8% of par value. So I'll be having 8%. Per value here is 100, and therefore we can agree our dividends to be 8. So quickly, once you've noted that, just come and show the examiner that you know what you're doing. So you have your dividends, 8. You have the value, which it can trade right now in the market. It can trade at 89. So that is what you are taking. So I'm having 89. So therefore, we can agree that if I told you to determine then our cost of these preference shares, how much will we be having? I'd be having 8 divided by 89 to give us times 100, of course. I'm going to about 8.99%. Volume is getting 8.99%. Kindly confirm on your end if you're getting the same values. After you are through with that, that should take us, of course, to the next element where you are asked to compute the cost of ordinary shares. So key E. Always recall that key E will always be talking about the retained earnings and will also be talking about what? The component of ordinary shares. So many a times, of course, if at all I'm not dealing with WMCC, in this case, considering only WCC, we have to focus on the ordinary shares. We have to focus on the ordinary shares. So therefore, to know or to determine the cost of equity, ordinary shares here, cost of equity, ordinary shares, that is what you're looking at. I know very well I should be able to get the expected dividends. With the expected dividends, I'm having the O, 1 plus G, that will give us expected dividends. We're going to divide by the value of our ordinary shares. We deduct any flotation cost or any discount that I could be having. Then I should not forget to add what? Our growth rate. I should not forget to add our growth rate. That is very important for us to note. So once we have this, my good students, of course, we proceed to the next item. The key element that I need to ask ourselves is, do we have these variables? Do we have these variables? That is what we need to ask ourselves. At this point, the O, this simply means the dividends per share, the dividends that we just paid, or the current dividends per share. Do we have this DO? I want us all to scan our eyes we take our eyes to note number 4. Last year dividends amounted to 3 million, which was 7% of the net earnings. So the dividends that we paid last year, the O, this is, remember these dividends per share, of course. So we paid 3 million. And this 3 million that we paid on how many number of shares? If at all you can check our capital structure, you can see that our number of ordinary shares, you're given 750,000 ordinary shares. So I'll be having the 3 million, we divide by the 750,000 ordinary shares. This will clearly give us a value of how much? 3 million divided by 750. I can clearly see that I'm getting what? 4. So that is very important to note. Dividends per share, the dividends that we just paid, the previous year's dividends per share, we can see we're having what? We're having the value of 4. So with a lot of confidence, I can come and say that therefore my DO is 4 into 1 plus G, or we're given our growth rate. Of course, in this case, you're given our growth rate, which you're given, you know that the dividends will be growing at the rate of 6%, so that is 0.06. Okay? We are going to divide all this by the market value of these ordinary shares, which in this case, it is not 5, and we've seen we'll be taking what? Whatever that they were trading at right now, which was what? 35. So we take, of course, the value of 35. We are going to add our growth rate, which is 0.06, given the fact that we didn't have any, component of what? Any flotation cost, or we didn't have, of course, any discount. So therefore, this should give us a value of what? I'm having, of course, 4 times 1.06. We're going to divide all this by 35. Then I'm going to add 0.06, which in this case times 100. Volume is getting 18.11%. Kindly confirm if we are getting the same values. Volume is getting 18.11%. You can confirm on your end if you're getting the same values with Molimu. After that point, we proceed to the next item where we are told to compute the cost of debentures. And the question that we're going to ask ourselves is, are we dealing with redeemable debentures or are we dealing with irredeemable debentures? In our case, clearly, we can see that in note number, that should be note number 3, check note 3 kindly. The debentures were sold in 2015 and realized 96 per unit. The current price is 80 and it's anticipated that a similar issue will also sell at 80 per unit. So we weren't given anywhere the component of maturity period. And if I'm not given anywhere the component of maturity period, I should know very well that we are dealing with what? We are dealing with irredeemable debentures or debt. So therefore, cost of debt for irredeemable, in this case, we should be talking of our interest. All of this you are going to divide by the value of the debt, if at all I'm having any flotation, and if at all I'm having any discount. I should not forget that we are looking at after tax. So therefore, 1 minus T. I should not forget that we are looking at after tax cost of debt. So therefore, 1 minus T. So in this case, my good students, you can all agree that our interest, Molimu guided us that interest will always be determined on the par value. Interest will always be determined on the par value. In our case, on that note, we've clearly agreed that because we weren't given the par value in our capital structure, but you're given the date that these debentures were sold, which was in 2015, and when they were sold in 2015, they were going at 96 shillings. So we're going to take that as our par value. So we're having 96 here. We multiply by the rate of this debt, the cost we are given, 10%. So therefore, we can agree that, therefore, the interest on this debt would be 10% of 96, which would give us 9.6. So here, Molimu is getting 9.6%. That is the interest, not 9.6 but 9.6 shillings, right? So that will be our interest. So therefore, clearly, we can determine our interest component here, and determining our cost of debt with a lot of confidence will say that my cost of debt, therefore, allow Molimu to remove this question now. I know by now we have it. So we will be taking, of course, the cost of debt to be my interest, which is 9.6. We're going to divide by the value of the debt. In this case, the market value of the debt, if at all you can see in our question, we had 80. So therefore, with a lot of confidence, you're going to have what? You're going to have 80 here. 9.6 of 80. I need to multiply by 1 minus t. The tax rate, we are given 30%. So 1 minus 30%, you can all agree, we're about what? 0.7. We are about 0.7. We are about 0.7. So therefore, it is our agreement that when you are talking about our cost of debt, this is now what we'll be having. We take our calculator, we have 9.6 divided by 80 times 0.7, which, my good students, you can see, times 100, we're getting a value of 8.4%. Mwalimu is getting 8.4. I don't know if you compute, what are you getting? We're getting 8.4%. So that is our cost of debt. That is our cost of debt. So once we have achieved this, the other question a good examiner wanted us to determine our weighted average cost of capital. Recall that anytime we talk about the weighted average cost of capital, we just want to look at the combined cost of raising these funds. And by looking at the combined cost of raising these funds, then we have to take an average of all these, then we add. And what will help us to determine that? I need to have what? My weight of each component cost. Say, for example, the first component is equity. So I need to have the weight of equity. I multiply by the cost of equity. We need to have, of course, our weight of debt. We multiply by the cost of debt. That is, of course, cost of debt after tax. We have to consider the weight of preference shares times the cost of preference shares. So summing this will give us what we are talking about, WCC. The most important question and the most important trick that you should understand at this point is determination of the weights. How are we going to determine these weights? To determine our weights, my good students, we have to use what? For the purpose of WCC, we have to use our market values. You see, so weights under WCC, we normally consider our market values of this component cost. And to know the market values, of course, of the component cost that you're looking at, you consider the capital structure. You consider the capital structure. So the capital structure, what you're given, of course, this is what you're given. Look at the capital structure for a firm. The capital structure for a firm, which in this case, I'll just have it below there. I want you to check your capital structure of the firm. We list it there. In this case, of course, you're having, number one, we have, of course, our ordinary, that is ordinary shares. We have our ordinary shares. We have the preference shares. Remember, the reason why we are not taking equity at this point, we are not taking the retained earnings. This is something, or rather, this is a component which is internal, and we can't issue it out. So anytime you're considering WCC, we don't take retained earnings. But when we'll be talking about WCC, we'll always be talking about what? The retained earnings. So that is important to note, okay? So we take the other component, which is preference shares. We take our preference shares. And the other component, we take debentures. We take our debentures. So most important would be, how are we going to determine the market values of this component cost? All that we are looking at is that if at all I was to value this component today, if at all I was to value this component cost today, how much would they worth? Remember, we talked about the component of valuation earlier on. So we start with the ordinary shares. Ordinary shares, you can see, my good students, that we'll want to look at how many number of ordinary shares did we have. We had 750,000 as per what the good examiner had given us. Currently, these shares, they are going at how much? We can get these shares at how much in the market? In this case, you can see we had a value of what? We had a value of 35, right? That is what we had. So this will give us the value of these ordinary shares to be how much? Of course, I'll be talking of 750 by 35. Mwalimu is getting, of course, 26 to 50. Our value is being in 1,000. I'm getting 26, 250. What about preference shares? If you check our preference shares, in that case, you are given each share per value was 100. So therefore, we take our 5 million, the value, we divide by 100 because it was going at that value, per value is 100. We multiply by the market value of these preference shares. The market value of the preference shares, you can see, which in that case we had, of course, to number 1, currently they can go at how much? Currently they can go at 89. Currently they can go at 89. So we multiply by 89. That is what we can be guaranteed. So 5,000, of course, divide by 100 times 89. In this case, Mwalimu is getting 4450. You can confirm on your end if at all we are arriving at the same values. So I'm having 4450. Just confirm on your end. What about debentures? The same case applies. The value of debentures given in our case, according to our capital structure, we had 7.5. Yeah, we had 7.5. And we agreed that this per value of debentures, in this case, because we weren't given anything else earlier on, we take whatever that was issued on the first day, assuming that is what you're told. Not assuming, but that is what you're told. It was issued in 2015 at 96 shillings, right? But today, these debentures, they can go at how much? They are going at 80. So therefore, that will give us what? The market values. So that's the easiest way on how you can always compute the market values, because I understand majority of the students, they normally have an issue of computing what? The market value. So therefore, we take 7,500 divide by 96 times 80. This will give us 6250. So once we have the 6250, let us get the weights of each component. So plus 4450, 26 to 50. So in this case, I'm getting a value of 36,950. 36,950. So if at all this is our market value, I need to determine my weight then. To determine our weight, this will be very simple, because I need to determine what is the proportion of ordinary shares to our total. The proportion of ordinary shares to our total, we can see that at that point, all I'll be required to do is to take 26 to 50, divide by 36,950. In this case, I'm having 0.7. So we take this one to be 0.7. 4450 divide by 36,950. In this case, I'm getting 0.1. And finally, 6250 divided by 36,950. I'm getting, of course, that should be 0.2, right? So I'm having 0.2, because the weight, of course, will always equate to 1. So once we have our weight, we want to achieve the component of WCC. So this will be easy because I have our cost. The component cost for KE, or cost of debt, not cost of debt, but cost of equity, that is ordinary shares, we can see we had a value of what? 18.11. So I'm going to take 18.11, whatever that you had computed. Cost of preference shares, we had 8.99. And cost of debentures or debt, we had 8.4. See, so this one we multiply. So that as at the end of the day, our WACC, what will we be having? Do you really want Mwalimu to clear, do you want Mwalimu to do this for us? And yet you have everything. Or you'll say like Mwalimu wafanye kazi yake, right? You'll say Mwalimu maliza kazi yako umeanza, right? So let us do this. I know this will be very quick. The first case, I'm having 0.7 times 18.11, of course. In this case, I'm getting 12.68. 12.68. 0.1 times 8.99. In this case, I'm getting, of course, 0.90. Because it is 0.899, so that is the same as 0.90. Then, of course, we have 0.2 times 8.4. In this case, I'm getting 1.68. So if we sum it up, that will give us our WACC. If we sum it up, that will give us our WACC, which in this case, with a lot of confidence, then we can have a 1.68 plus 0.90 plus 12.68, which Mwalimu is getting 15.26. I don't know what you guys you're getting. I'm getting 15.26%. So Mwalimu is getting 15.26%. So this will be our WACC. So Mwalimu was taking us through all the steps, of course, of computing the WACC. And this is how easy this concept always is. So we have a lot of videos, of course, which you've done, and you can always get them, of course, if at all you are watching this video on YouTube, you can always get a lot of these videos in our application, which is app.mdarasa.com. app.mdarasa.com. This is where you can get all the videos for FM, of course, which will always help you to understand more of this concept. So in our next class, I want us to look at a concept whereby we are dealing with the concept of WMCC, the weighted marginal cost of capital, so that you can clearly get the difference between WCC and WMCC. To that point, guys, thank you so much, and I hope to see you in our classes. Of course, you can always reach us out on 0708 068 851. These are numbers that you can always reach